Yeah, that's kind of the market volatility aspect, which I think is probably a lot of people's number one fear in that like the first year they retire, the market's down 20%, and then maybe a second year it's down, I don't know, 10%, which is very rare for the market to be down 2 years in a row, but it has happened before. And I
Hmm.
think that's one of people's biggest worries because if your market's down 20 and you're pulling on a few percent, I mean, you could be down mid 20s at that point, and then if it's down again, there goes, 30% of your portfolio. But I think by having a plan, having some cash set aside or some bonds or shorter term investments that you can pull from in those times, not necessarily have to sell stocks while they're down, um, is kind of a good way to go about it. So that when the market does recover, you didn't have to sell, maybe you had to sell a little bit of stock to get through, but you didn't have to sell a lot of it to be able to, make bills in retirement or those first couple of years while the market was down.
Yeah, I'm sure that those people that were retiring after COVID and 2021, 20 and 2021 and whatever, and then 2022 hit, it's probably their first year of true retirement. They were probably freaking out.
Mm-hmm.
That was such a
Yeah.
down year. And I mean, I guess you got to plan for the worst to happen
Yeah,
right away.
extremely important. We have a scenario in our planning software where it's like um, bear market scenario. Like let's say you retire and the first year you retire, the market's down 25%. What does that do? And is it going to have an impact on retirement? Absolutely. It's going to have an impact. And that's kind of outside of your control. It's one of those things where you're kicking off your first year of distributions with a portfolio that's down. Hopefully if you're diversified, you've got some fixed income in there, you're not down quite as much as the stock market. But if you're still down in your portfolio, that's going to be a lot, that's going to have an impact 30 years later. As opposed to what if the market's up 20%, you're going to have a different impact 30 years later. But those are the things that you can't control. We're trying to say, okay, despite those things, are we going to make sure you're not going to run out of money? That's number one priority. And those are things that we walk through and plan for.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.